There were several items in the Act that affected personal income taxes. The first is special rules for using retirement funds for coronavirus costs. Typically, if you take money out of a qualified retirement plan before age 59 and a half, you not only pay income tax on the distributions, but there's a 10% penalty as well. There are several exceptions to this penalty, and the CARES Act added a new one, allowing a taxpayer to take a coronavirus-related distribution of up to $100,000 in 2020 free from the penalty. Now, a coronavirus distribution is defined as one that is during 2020, and it's to any of the following. So you have an individual who was diagnosed with COVID-19 by a test approved by the CDC. You have an individual whose spouse or dependent is so diagnosed, or you have an individual who experiences adverse financial consequences as a result of being quarantined, furloughed, or laid off, or having work hours reduced, or being unable to work due to lack of childcare. Now that particular item, just what is included in adverse financial consequences, how significant does it have to be, that kind of thing is yet to be discussed, and we don't really have any rules on that right now. While the distribution escapes the 10% penalty, it still does have the income tax. The Act, however, allows the taxpayer to spread the income over a 3-year period beginning in 2020. The taxpayer also has the choice to avoid any income recognition at all by repaying the distribution to the retirement plan within 3 years of receiving it. This rule applies to distributions made both from eligible employer plans as well as IRAs. In addition, the amount an individual may borrow from his or her retirement plan is increased from $50,000 to $100,000 for loans that are taken out within 180 days of the enactment of this Act. And the last thing on this is that for those that are required to take a minimum distribution, an RMD, from their plan in 2020, that requirement is waived for this year only. There were also some changes to charitable contributions. Up to this point, charitable contributions have been itemized deductions for individual taxpayers. However, due to the new higher standard deduction, only about 8% of taxpayers have itemized. So if a taxpayer wasn't in that 8%, if they were in that 8%, they got a benefit from the charitable contribution, but most people who were not did not get to get any benefit from their deduction. So to provide a broader benefit, the CARES Act allows an individual to make a cash contribution of up to $300 to certain qualifying charities and deduct that contribution above the line, so it's deducted before you get to adjusted gross income. The taxpayer thus receives a deduction in addition to the standard deduction that they would get. This above the line deduction is here for 2020, and this right now says and beyond, but there is a question as the law was not really as precisely worded as it should have been. And so there's a question of whether it just applies in 2020 or it starts in 2020 and then goes beyond that. So that's an open item right now. But again, that would be available to people that don't itemize and would not be an additional deduction for those that do. For those that do itemize, the new law temporarily lifts the limits on charitable giving for 2020. Cash contributions to public charities are generally limited to 60% of adjusted gross income. The CARES Act allows such contributions to be deducted up to 100% of AGI for 2020, with any excess contributions available to be carried over the next 5 years. And then one item in here for corporate taxpayers, and that would be C corporations, corporations that pay their own income taxes. The limit on deductions would be increased from the current 10% of adjusted taxable income to 25%. And the final item in this section then is that income exclusion from income for employer payment of an employee's student loan debt. So as a general rule, if someone pays your debt, that's taxable income to you. As part of the act, an employer can pay up to $5,250 in 2020 of an employee's student loan obligation on a tax-free basis. This does, however, change a provision that's already in the law, which permits an employer to reimburse an employee up to that same $5,250 as a qualified educational expense, which would be tax-free to the employee. This change now combines this limit. So, for example, if an employer could pay $3,000 towards an employee's master's degree and another $4,000 to previous student loan student loan debt for 2020, but the maximum that would be tax-free is still that $5,250. And to the extent then that an employee student loan is paid on a tax-free basis by this new section, his or her employer, the employee can then not deduct that same interest or the interest on that loan. Any questions on those subjects?
Yes, Lon, sorry, we have a couple of questions.
All right.
Do you have to ask your financial institution to waive the RMD for 2020?
It's too early to tell exactly what the procedure is for that. I think that if somebody has an automatic RMD calculation in their account, they might want to discontinue that now until they know. And I believe this would be one of those things that each institution might have its rule on how to go about doing this, but I don't think there is any common thing out there now that everyone is supposed to do.
Okay, and regarding the charitable contribution, is the limit $300 in total, or can you have multiple less than $300 contributions?
No, it's one total of up to $300, and it doesn't need to be to, generally what you would think of as a charity. Some people have donor advised funds where they put money in, say for this year, and get a deduction in the current year, but don't disperse the money later. This is money that really has to go out and go to a charity for its use in 2020.
Okay, it looks like that's all of our questions for right now.
All right, thank you.